Danny speaking. Uh, Hi and welcome everyone. It's 5 to 1. So it's still another few minutes for one. I'm going to give it a few minutes after one for everyone to get in because I'm still having a few people phoning and having issues. So welcome. In the meantime, just get settled and we'll start just after one. All right. Thank you.
Okay, it's 1 o'clock, so we are due to start at 1, but we're going to give it a few more minutes just to allow everyone to join. So we'll
Okay.
start promptly at 5 past, just to put a timer on it. And so you've got a chance to go and get yourselves ready. If you need coffee, tea, whatever you like, even a glass of whiskey. I don't know if you need that at this time of the afternoon, but we'll be ready to start at 5 past, and there will be a break some around for 15 minutes around 20 to 2:30.
First, yeah.
Uh, and Prof. Jackie will sort that out when the time comes, at appropriate moment. So just give us a few minutes. We'll start promptly at 5 past, and get yourselves ready. Thank you. Okay, so we are actually on 1305. Welcome everybody to this session on the TAA and VAT update, all the laws and the tax administration, etc. And as usual, we're very pleased to have Prof. Jackie Arendse to tell us and give us the lowdown. And as I said a little earlier, we will be having a break at about 20 past or half past 2, just to give about 15 minutes, and Jackie will give us the timing. And so, Jackie, without further ado, the floor is yours.
Lovely. Thank you so much, Stan. And thank you, Danny. And welcome to everybody. Lovely to be connecting with you again. There's always lots to talk about in the world of tax and tax developments. And so today, yeah, TAA and VAT, probably more TAA, as always happens with tax, is that the focus is always more on tax administration. Most of the cases that come through these days are dealing with tax administration. There's always a lot of aspects to look at there. So we will look at a few tax cases in the first part of the webinar. And then in the second part, we'll pick up on SARS documents and notices, just some recent documents and notices that SARS have published in the Government Gazette and also put onto their website. Looking at the filing season, looking at the VAT guide that they put out recently on schools exiting the VAT system. That follows an amendment that came through in last year's amendments that were promulgated 1 April 2026, basically taking all schools completely out of the VAT system by making all of their suppliers exempt suppliers, which means schools have to deregister as vendors, and there are obviously some VAT implications that go along with that. And so we'll run through that guide and just go through some of the main aspects of that. And then SARS also, and I'm sure you've probably seen quite a lot about this on social media and so on, the online traveller declarations that now have to be completed, whether you're exiting South Africa or coming into South Africa. So I'll just give you a bit of a heads up on that. And then an interesting draft guide. Now, ordinarily in a webinar, I wouldn't really talk about draft documentation, but because this is something that's quite topical, and because it comes at the time of the filing season when people are compiling tax returns and so on, I think it's really important to just have a look at what SARS is saying in this draft guide on the taxation of crypto assets. Okay, so quite a lot to look at, and we'll start off looking at the tax cases, and we're going to be looking at 3 cases today, all dealing with aspects of tax administration, although BASF also cuts into transfer pricing, but the aspects of the case really deal with tax administration issues. But we're going to start off looking at the latest Constitutional Court judgment of Louis Metals versus SARS. And actually this judgment, this was one of the 5 tax cases. You may remember in the previous tax webinar when I was talking about the ABSA judgment that was handed down in April this year, dealing with the general anti-avoidance provisions. And I mentioned that that case had gone through the High Court, the SCA, and then to the Constitutional Court on the question of whether it was suitable for a High Court review. And there were 5 cases that were heard simultaneously with that Constitutional Court judgment, and that judgment was handed down early in 2025, but it was actually considered about 6 to 8 months before that. But Louis Metals was the other successful outcome of that Constitutional Court judgment. So out of the 5 cases that went to the Constitutional Court under the one umbrella of United Manganese versus SARS and 4 other cases, so out of those 5 cases, 2 were successful for the taxpayer in terms of saying, yes, they could be subject to High Court review under Section 105. One was ABSA on the GAR provision, and the other one was this one, Louis Metals. So after the decision was made that they were suitable for review, for a judicial review of SARS treatment and SARS interpretation in this case, so then it had to go back to the Constitutional Court to consider the actual details of the case itself. All right, so that's what's happened here. So we've got Louis Metals that's come through with this judgment, looking at the specifics around the taxpayers question here, which we'll get to in a moment. And then we've got two high court cases, BASF, as I say, dealing with transfer pricing. And then, but actually what this case deals with is the changing of the grounds of appeal. And also with SARS, looking at changing their grounds along the way. And the taxpayer also changing their grounds. So cutting into Rule 31 and Rule 32 of the tax court rules, looking at to what extent can you change your grounds of appeal, or in SARS case, the grounds for assessment. And then in CSARS versus Mayring Citrus, so this is a bit of a reversal of an outcome of a couple of years ago, probably about 2 years ago, where it was actually found in favor of the taxpayer. Then SARS took it on appeal, and well, I've kind of given you a bit of a spoiler alert there, that SARS was successful here and the taxpayer lost this case. And yeah, quite an interesting outcome there, dealing with insurance, or the question is, was it really insurance, or was it a form of an investment that the taxpayer had invested into? But quite kind of a widespread insurance product that had been sold especially to farmers, starting a few years ago and then running through, and then of course coming again, SARS looking at whether those insurance premiums were deductible. Yeah, so that's a straightforward income tax issue around the deductibility, and we will get to that in due course. So as Stan alluded to, we're going to go through until around 2:25, 2:30. I think that's about as long as anyone can take in one session on a webinar. And so then we'll stop for sort of 15 minutes and have a leg stretch, a coffee break, tea or coffee, and whatever else you want to attend to during that time. And then we will carry on with the second half of the webinar. And the plan is to be done by 4 o'clock. I don't think we'll go as late as 4. Looking at the content of the webinar today, it's not too dense. Well, it's still got a lot of technical details, so brace yourself. But yeah, it certainly shouldn't take us over time. Right, so let's start off looking at this case of Louis Metals versus SARS in the Constitutional Court. It is quite interesting to see how many tax cases are going to the Constitutional Court these days. The question is always in my mind as to whether it's appropriate. And I think I raised that in the ABSA judgment, because remember that ABSA could have dealt with that dispute going the normal dispute resolution process. When SARS raised the additional assessment applying the GAR provision, ABSA could have objected, just gone that normal route. But they were trying to short circuit the process by going for a Section 105 review, asking the court to intervene and kind of review, look over the shoulder of SARS and say, were they correct in what they did in raising that additional assessment, and was their approach correct? And well, it certainly didn't turn out to be a short circuit process, although I suppose in some respects, maybe it was. It started in the High Court in 2021, ended up in the Constitutional Court in early 2026, so 5 years, let's call it. And I mean, sometimes the objection and appeal process can go on close to 10 years. So perhaps it did short circuit, but you do just wonder whether it would have been more appropriate to take that matter through the normal objection and appeal process. Now, this case also, but here, the taxpayer, it was a slightly different approach, although it was still looking at Section 105 and taking an application for review to the Constitutional Court. But here, it wasn't a review of the SARS process. It was an application for a declaratory order to clarify the interpretation of this provision. So I'm not quite sure I'm getting this thing in the middle of my screen. But anyway, so in this Constitutional Court judgment, having gone the whole route of the High Court, and then, of course, the dispute around whether that was appropriate for a High Court review, etc., it then went through to the Constitutional Court, as I say, with the 4 other cases, and the Constitutional Court decided in early 2025 that it was appropriate for a High Court review. And then, of course, it went back to the Constitutional Court to actually look at the merits of the particular case. And that's what we're dealing with here. So this judgment was handed down 23rd of June 2026. And it's looking at a statutory interpretation of the VAT Act, and in particular, Section 11(1)(f) of the VAT Act. Now, if you think about it, Section 11 of the VAT Act deals with zero rating, right? It lists the various zero-rated suppliers. If you think about the basics of VAT, any supply made by a vendor in the course of carrying on an enterprise carries VAT, either at the standard rate of 15% or at the zero rate of obviously 0%. Then on the other hand, you might have exempt suppliers, which essentially fall outside the VAT system. But your zero-rated suppliers, such as Section 11(1)(f), that really is the best situation for a vendor to be in from a cash flow perspective, because it means that they are in fact taxable supplies. All of these supplies are taxable supplies, but they carry VAT at the zero rate. So you've got zero output tax, and yet because they are taxable supplies, the vendor is able to claim their input tax. Now, it does result in a bit of a headache. Every single VAT return that goes in results in a VAT refund, and that means inevitably there's a call for verification by SARS, and so there's a lot of documentation that has to be provided. But in essence, if all goes well, getting a refund on every VAT return is obviously much better than having to pay VAT in. Now, the thing is that with your zero-rated supplies, because it is the best situation, the most advantageous situation for a vendor to be in from a financial point of view, these zero-rated supplies are very specific. I mean, if you even just think about the zero-rated supplies relating to exported goods, it's very specific in terms of it being a direct export, and you have to have all the correct documentation, etc., etc. There's even interpretation notes that go along with the legislation clarifying exactly what documentation you have to qualify for the zero rating. And with all of these different zero-rated supplies, they are very specific. And so when we look at Section 11(1)(f), which is just one type of zero-rating supply, and being 11(1)(f), it's talking about a supply of goods and services, whereas 11(2), a supply of goods, whereas 11(2) talks about the supply of services. So 11(1)(f) talks about the supply of gold. And I'll come to the exact wording of the provisions in a moment. But because of what I've already said, you can get the idea that the zero rating provision is very specific, although the wording, the way it's worded, and you'll see this in a moment, it's maybe not as explicit as it should be. But if you think about the objective and the purpose of approach to interpretation, what is the purpose of this provision? What is it intended to accomplish? Then we have to come to the conclusion that it would have a very specific intent, and that you'd have to carry that through in the interpretation. Now, Louis-Vuitton Metals, on the other hand, took a broader approach in their interpretation, and they came to the conclusion that their supplies that they had been making for many years, I think over a decade, to ABSA, as it turns out, although totally unconnected to the other Constitutional Court case, but they had been supplying gold bars, and they had been zero rating those supplies. They had various reasons for doing that, but it all links to the interpretation of this particular provision. Then SARS came across later, did an audit, and then said, actually, no, these supplies should never have been zero rated. Obviously, that resulted in a huge amount of VAT having to be paid across to SARS. So Louis-Vuitton, the way that they dealt with this is they approached the High Court in 2022 for a declaratory order. So here's going to the court and saying, can you please provide a declaratory order clarifying the application of 11(1)(f). So give us your interpretation regarding the supply of gold to ABSA, which is obviously a registered bank. So what happened all the way along the line is that Louis-Vuitton purchased gold containing items which had previously been refined. So they had, part of this was secondhand jewelry, etc. Okay, so they'd buy up gold from all over the place, and then they would melt it down into gold bars. So that gold had previously been refined and thereafter was mainly manufactured into gold coins and jewelry pieces. Louis Vuitton then bought that and melted it down into gold bars. So it processed these items into gold bars, which constitutes refined gold. And when you look at it manufactured into one of the 8 forms listed, so that's one of the requirements for the 0 rating, is that the gold must be in one of these 8 forms, which I'll show you in a moment. And the other requirement of 11.1F is that the gold must be sold to one of the designated recipients, as it were. And those are 3 categories: the South African Reserve Bank, the South African Mint Company, or a registered bank. So ABSA was a registered bank, so we had the right recipient. It was manufactured into one of the 8 forms, so that's okay. But the question was the extent to which it had been manufactured, because I don't want to say too much too soon, but the interpretation from SARS side was that there should have been no real manufacturing entered into, no further processes entered into, other than simply reducing the gold into a gold bar. But remember that they were taking gold that had been jewelry pieces and gold coins, so there had been something that had gone on to make it into those forms. Then it was reduced down to the gold bars. Now, the High Court held that the provisions of Section 11.1F did not apply to the supply of gold which was derived from gold which had previously been refined and subsequently undergone any manufacturing process. So they found against the taxpayer. And that's when the taxpayer appealed, and on appeal right through to the SCA did not consider the merits of the case, but they just dismissed it on the basis that it wasn't appropriate for a judicial intervention. And that's when Louis Vuitton applied to the Constitutional Court, together with the 4 other cases, as I mentioned, back in 2025. That judgment was handed down. And the judgment of the Constitutional Court was that it was appropriate for a High Court consideration. So the High Court then, remember, they had looked at this in 2022 and they'd found against the taxpayer. So now the Constitutional Court is looking at it essentially as an appeal against that decision. Okay, so if we look at the VAT Act, Section 11.1F, what does it actually say? So as I say, Section 11 talks to 0 rated supplies. And this one says one of these 0 rated supplies, let me just go back to the introduction of Section 11.1. It says, where but for this section, a supply of goods would be charged with tax at the rate referred to, in other words, a standard rate, such supply of goods shall, subject to compliance with subsection 3, be charged with tax at the rate of 0%. Okay, so supply of goods would be 0 rated if it fits into one of these categories listed in Section 11.1. So if we get to 11.1F, it says the supply to, and here we go with the 3 types of recipients: the Reserve Bank, the SA Mint, or any registered bank. Okay, so there's point number 1. And then it talks about of gold in the form of, and here you see the 8 different forms. Has to be in one of these forms: bars, blank coins, ingots, no, just blank coins, ingots, buttons, wire, plate, granules, or in solution. Okay, so it's got to be in one of those forms. And then the third requirement is that it must not have undergone any manufacturing process other than the refining thereof, or the manufacture or production of one of those 8 forms. And so I've highlighted this part here, but the exact wording says which has not undergone any manufacturing process. So the key thing in Louis Vuitton's case is, has that gold undergone a manufacturing process? In essence, actually, what they had to look at very carefully in this judgment is the interpretation. What do you mean by a manufacturing process other than the refining thereof? What is the interpretation of this wording? Now, looking at that phrase, which has not undergone any manufacturing process other than the refining thereof. So they were looking at whether prescribed forms of gold precluded recycled or second-hand gold from being 0 rated. Remember that Louis Vuitton had taken gold jewelry, gold coins, and melted that down into gold bars. So was that regarded as having undergone any manufacturing process? Not just by Louis, but at any stage, has that gold undergone any manufacturing process? That's really what you have to look at. In interpreting the wording of this, the court looked carefully at the purpose of 11.1f. Why do we give zero rating? It is a concession that the fiscus is giving to the taxpayers in this case, because we're not getting any output tax, but they're getting the input tax that they can claim against this taxable supply carrying VAT at the zero rate. So what would be the purpose? And in the High Court judgment, going back to the High Court judgment, in paragraph 6.6, it says, the purpose was to provide the mining industry with a favorable tax regime intended to promote and enhance the economic viability of gold mining in South Africa, to extend the lifespan of the mines, including marginal mines, within the context of this highly capital-intensive industry, which plays a vital role in the South African economy, etc. So the idea is to give the mining industry a concession. But as I've mentioned, whenever you have zero rating, the zero rating provision is always very specific. And if there's ever any doubt, because of the intention behind the zero rating provisions, that it is a concession that is given in very specific circumstances, in doubt, one would normally adopt a more narrow interpretation. So when we look at the three requirements of 11.1f, it has to be a sale to one of the prescribed purchasers, the Reserve Bank, the Mint, or a registered bank. The gold must be in one of those 8 prescribed forms that I showed you in the provision, and it must not have undergone any manufacturing process other than refining or the manufacturing or production of one of the prescribed forms, but not any other manufacturing process. So in paragraph 10 of the judgment, it states that the High Court held, looking back at the High Court judgment, the High Court had held that a proper interpretation of this provision is that gold which has undergone a refinement or manufacturing process prior to the refinement that Louis Metals was doing would not qualify for zero rating, taking a much more sort of narrow approach, which, as I say, would be appropriate in terms of interpreting these zero rating provisions. But Louis argued that the provision required that the gold to be supplied must be in a prescribed unwrought form and must be supplied to a prescribed purchaser. But the court held that 11.1f requires that the gold must not have undergone this manufacturing process, etc. And so it was held that recycled or secondhand gold had indeed undergone disqualifying historical manufacturing processes way back, okay, in making it into jewelry, making it into gold coins, etc. There was a process that was undertaken at that point. And so now you take that gold and you melt it down and refine it into gold bars, then you cannot escape the fact that there has been a manufacturing process, and therefore the zero rating provision would not apply. So when they were applying various principles of interpretation, they did make this point of rejecting so-called blind literalism. They were saying, when you look at statutory interpretation, we take a purposive and contextual approach, not a purely literal approach. A literal interpretation in this case would lead to commercial absurdity, treating a unique piece of jewelry the same as a raw gold bar. So the Constitutional Court emphasized that words in a statute must be understood within the specific scheme and objectives of the Tax Act, the VAT Act. The judgment noted that a narrow focus on the substance, which was the gold, ignored the functional and commercial identity of the goods being traded. So the ruling at the end of the day, after all of that, and again, who knows how many hundreds of thousands of rands, maybe millions in legal fees going all the way to the Constitutional Court previously and now back to the Constitutional Court, and ultimately the appeal was dismissed with costs, including the costs of 2 counsel. So I would imagine not a very happy day in the offices of Louis Metals. I didn't mention earlier, but I'm sure you're all quite used to my webinars, that if you have any questions that you would like to raise, you're very welcome to pop them into the chat box, or if you want to interrupt me and ask something, just let me know. pop your hand up. I'm sure Stan or Danny will keep an eye on that and let me know if I need to pause and hand over to somebody to ask a question. Otherwise, you're welcome to pop a question into the chat box. All right, so after all of that, much ado, much consideration, the outcome was that the zero rating did not apply in Louis Metals' case because they were taking gold that had been converted into gold coins and jewelry, now reduced back down to gold bars. So although the quality of the gold was unaffected, the fact is that it had been converted and now reduced back to a gold bar. So it wouldn't qualify for zero rating. So it certainly does put a bit of a dampener on that kind of secondhand gold industry and in terms of the VAT treatment of that. And I would imagine that Louis would have a massive VAT bill that they would now have to pay back to SARS, considering all the VAT over the years that had not been paid across. Okay, then we get to another rather sad story of Mayring Citrus. I'll get to BASF just now. See, I've jumped the order around here a little bit. But Mayring Citrus, interestingly, a citrus farm down in the Sundays River Valley in the Eastern Cape, which I believe has become the biggest exporter of citrus in the country, becoming the most important area of exported citrus. Of course, we also have a lot of citrus produced up in the northern parts of South Africa, but the Eastern Cape is a massive area of citrus production. And Mayring Citrus, no doubt carrying on farming operations of lemons, oranges, etc. All these lovely things that we see at this time of the year when we drive around the countryside. Now, Mayring Citrus had a dispute with SARS regarding the payment of an insurance premium. And initially, Mayring Citrus submitted their tax return, claimed that insurance premium as a tax deduction, and they were assessed on that basis. But then when SARS went back later and did an audit, they disallowed the deduction of the insurance premium. And it also raised the question of prescription, because when they raised the additional assessment, they did that more than 3 years after the original assessment. And so the taxpayer raised that point of whether a prescription should not have applied. And we'll have a look at that question just now. And then to make matters even worse for the taxpayer, not only did SARS raise the additional assessment for the tax on the disallowed insurance premium, which was just short of R1 million, 10 million Rand, it was 9.4 million Rand. 9.6, I'm getting my numbers all mixed up here. Anyway, it'll all become clear as we go through the slides. But yeah, so the tax on that disallowed insurance premium of 9.6 million Rand, plus an understatement penalty. All right, and the fact that SARS raised the assessment more than 3 years after the original assessment. So let's have a look at this. So as I say, the taxpayer carried on farming operations and they paid this 10 million Rand insurance premium, which they classified as an insurance premium, to secure insurance cover of 12 million Rand. Okay, quite interesting. You pay 10 million to secure insurance cover of 12 million against the risk of crop losses. Now, farmers and citrus farmers especially face huge risks around crop loss, because if you think about the issue with oranges, etc., that get exported, they end up in a harbor over in the Far East or in Europe. And if the oranges are found to show evidence of black spot or codling moth, which are two of the things that typically afflict these citrus products, then the whole batch can be rejected at that foreign harbor. And obviously that would result in massive loss to the farmer. In fact, I heard an interesting point from a farmer was telling me this the other day, is that another risk that came about is because with the developments of biotechnology, etc., they had worked out ways to prevent this codling moth from being on the oranges and so on. And they worked out a way of doing it without chemicals. And then what happened is that when these oranges arrived in the harbor overseas, their tests showed that there were not enough chemicals on those oranges and they were rejected on that basis. So yeah, it seems like it's kind of a lose-lose situation. But anyway, so you can see the kind of risks that these farmers face. So it's not just the risk of of drought or hail or fire. It's also this risk of the oranges or lemons being somehow contaminated or afflicted with some sort of biological product or issue, and then they get rejected. So to mitigate against the risk of these crop losses for 7 months. Now, it's interesting if you look at the timing of this. For a 7-month period from June, well, that looks like, yeah, June to December 2017. And it turned out that this all came about when the taxpayer was doing its provisional tax return. And if you read between the lines, it looks like they wanted to reduce their taxable income. And then the accountant said they remembered going to a presentation from an insurance salesman who was telling them all about this wonderful product about insurance cover that you could actually get your money back. And so they decided to take up this insurance cover. And obviously they paid up this big premium up front. And so it did have the effect when they claimed that as a tax deduction, or it had an effect of reducing their taxable income. In terms of the contract, it stated that in the event of a claim, the insurer will pay claims from the balance in the so-called experience account up to the maximum of the policy indemnity limit, which was 12 million. But if the total claim exceeds the balance in the experience account, bearing in mind that they've put in 10 million, the maximum claim is limited to the policy indemnity limit. Okay, the value of the premium was credited to the experience account, reduced by an underwriting fee and claims. And then there was certain interest, and they called it notional interest, that was added from time to time to the balance on the experience account. And in the 2017 year of assessment, there was this notional interest of 1198. Not a large sum of money, but keep your eye on that number. It features later on. And that notional interest that was added to the experience account of the taxpayer in the books of the insurance company was not declared in the taxpayer's 2017 tax return. And what they claimed was a deduction of the 10 million rand premium. Okay, then what happened is that, so they took this policy, remember, for the 7 months up to the end of December 2017. And then in January 18, they did a so-called policy cancellation, where the account balance was returned to the taxpayer, but immediately thereafter it was credited back. So they kind of just rolled it over into a policy renewal. They didn't make any claims on the policy, so they were fortunate enough not to suffer losses, and they didn't claim on the policy. And then, you can see here, like 3 years later, 3.5 years later. So they obviously rolled this over, kept it going, kept the money in the experience account. Then they decided to take the money out. So they gave notice of cancellation. They said due to a smaller crop and lower prices due to the exchange rate, and they needed the money. So the credit in the experience account at that time, because it had grown with this interest amount, the notional interest, so the credit balance was their 10 million they put in plus an extra 1.3, and that was paid out on the 9th of July 2021. And that amount was included in the taxpayer's taxable income. So remember, they had claimed the tax deduction back in 2017 when they paid the insurance premium. And then when they got this amount paid out, they included the whole amount of 11.3 at that point in their taxable income in the 2022 year of assessment. Okay, but because they were in a tax loss position in that year, no tax was actually paid. So it certainly does sound like there was a lot of timing going in. They claimed the 10 million, obviously in a year where it looked like they were going to have taxable income. And then they got paid out the 11.3 in a later year, sort of 3.5 years later, in a year when they had a tax loss. So there was no actual tax payable, but obviously it would have reduced their assessed loss. Right, so they had their 2017 assessment. Oh, sorry, I've just take this out of the way. Issued on the 18th of December 2017. So remember, because it's 2017 obviously went through to the end of Feb 2017, so the assessment issued They submitted their tax return, got assessed on the 18th of December 2017. SARS then conducted an audit and issued a finalization of verification in April 2018. Okay, so a few months later, nothing untoward there. And they indicated at that stage no adjustments. So everything looked fine, taxpayer was happy. But then, some 2.5 years later, SARS notified of a further audit. That was now in December 2020. Now have a look, the original assessment issued in December 2017. Now SARS is doing a further audit in December 2020, more than 3 years later, okay? They then issued a letter of findings in May 2021, in which they notified the taxpayer that actually the 10 million Rand premium would be disallowed. Well, ultimately, they allowed 400,000 of that being fees, but they disallowed 9.6. But initially, they disallowed 10 million, and they said that notional interest of 1198, remember that in 2017, that must be included in gross income. SARS recognized that the assessment had prescribed, but they intended to reopen it on the basis of Section 99(2) of the Tax Administration Act, saying that the failure to assess the full amount of tax chargeable was due to a misrepresentation by the taxpayer. And that misrepresentation was the failure to declare this notional interest of 1198. All right, so yeah, so SARS was basically saying that the prescription, the 3-year prescription, did not apply because there was because they showed that the failure to assess the full amount was due to a misrepresentation by the taxpayer. All right, so they then went ahead and raised an additional assessment for the 2017 year. They disallowed that insurance premium of 9.6, right? The 400,000 sort of admin fees they allowed, disallowed 9.6 million, saying that that did not constitute expenditure, not of a capital nature. They were arguing that that was more in the nature of an investment. It was not insurance expenditure. They added back 1198 being the notional interest. They said that should have been included in income for that year. And then on the shortfall of tax, they then imposed a 10% understatement penalty on the basis of a substantial understatement. And they charged Section 89 quat interest on the underpayment of the provisional tax, right? Because 89 quat is the interest that comes in on whatever tax is still outstanding after the effective date, which is, in this case, 7 months after year end, what tax was still outstanding, and there would be 89 quat interest on that. All right, so during the course of the dispute, when the taxpayer objected against the assessment, the additional assessment, during that process, SARS agreed to waive the interest, but the other issues remained in dispute. And of course, a big question was whether that 3-year prescription applied under Section 99(1). Okay, so if we look at the judgment, they go into a lot of details around the essentials of a valid insurance contract, which are interesting, but they're not integral. Although I guess in some ways it is integral if you're looking at insurance versus an investment product. But when you look at the deduction of an insurance premium, you're claiming a deduction under the general deduction formula. So you're looking at expenditure actually incurred, which is not capital in nature. Now, when the judgment was looking at the essentials of a valid insurance contract, they said there's 4 key aspects. So one is risk transfer and spreading. They said a valid insurance contract must involve the transfer of risk from the insured to the insurer and the spreading of that risk among a large group of persons. They said traditional insurance relies on the economic theory in which a relatively small premium is paid to cover potentially large losses. I mean, if you think about even an insurance you pay on your car, the premium that you pay every month or every year, and if your car is stolen and the insurance company replaces it, what they're paying out is way more than what you're paying in insurance premiums because of this economic theory and the statistical probability that you are going to have a claim. All right, so that's the other aspect of this principle of economic theory and statistical probability. In genuine insurance, the insurer determines the premium based on a risk assessment, where the insured determines the premium to match a desired tax deduction. Where that happens, the arrangement is likely not insurance. Now, remember, in this case, they were paying 10 million Rand as a premium, okay, minus 400,000, which was fees, but then that was going to give them insurance of 12 million. So it wasn't really a huge amount of additional cover that they'd get relative to their premium. So they were saying that here it was more a situation where the premium was kind of matching the payout. The payout was only slightly more, representing a kind of a return on investment situation. Structured products where the premium is largely refundable upon demand, even after risk has attached, fail the legal test for insurance. And this is a key failure of this particular product, is that the insured person, the farmer, had the opportunity to pull out of the contract at any stage, obviously after an initial period. But thereafter, they could say, right, we don't want this anymore, please give us our money back. Now, normally on a normal insurance contract, you wouldn't get your money back, right? Every month that goes by that you pay your premium, you either claim or you don't claim. But this relied on the basis that your so-called premium was refundable on demand, which looked much more like an investment deposit. All right, so when the court was looking at, is this expenditure actually incurred? What is expenditure? When you look at expenditure, an expenditure involves a diminution of assets. All right, that you're paying out cash or you're incurring a liability, you're reducing your assets. Even if you're doing a barter transaction, you're giving up something in order to get something. So you are reducing your assets. The payments made against an unconditional right to the return of an equivalent sum, similar to a loan or bank deposit, do not constitute expenditure. So you're paying something, but you're going to get that back, then that's not expenditure. Substance over form tells us that simply labeling a payment as an insurance premium does not create a deduction if the taxpayer retains an absolute right to recover the funds. I mean, we even have a provision in Section 23 which says that if there's any expenditure that is recoverable, it is specifically prohibited for deduction. And certainly here, where you're saying we're paying an insurance premium and we have a right to get that back, even though it might be sometime in the future, the court said that is not expenditure actually incurred. And parting with cash to acquire a credit in an experience account is merely a change in the form of an asset, converting one asset into a type of an investment. It's not a true spending of funds. And so on that basis, taking those four principles into account, the court came to the conclusion that the premium paid of the 9.6, so out of the 10 million, the 400,000 that was fees and admin costs, certainly that was expenditure actually incurred. But the 9.6 balance, the net amount of the premium as such, was not expenditure actually incurred. It was really more in the nature of an investment. So looking at that tree and fruit analogy, going all the way back to our old cases, capital revenue, tree and the fruit, funds in an experience account constitute the principal or income producing asset, which is akin to the tree, while the generated interest is the fruit. Enduring value, looking at the rights to funds in an experience account that do not expire with the period of cover but subsist and can be pledged as security, indicates that we have something that is capital in nature. So the purpose of the outlay, while protecting the crop, is a business purpose. An outlay that secures an asset of a lasting value is still capital expenditure. So that interest-bearing account, that experience account, created through structured insurance, is an independent income-producing concern, and that is a capital asset. So the 9.6 million that went into that experience account was regarded as effectively capital expenditure, not expenditure actually incurred. And so the court concluded that the deduction should not, in fact, be permitted. And of course, that 1198 interest should be included in income. But what about the 3-year prescription? Now, if you look at Section 99 of the Tax Administration Act, Section 99(1) tells us that an assessment may not be raised more than 3 years after the date of an original assessment by SARS. And of course, if you're talking about a self-assessment, the prescription period is 5 years. Okay, so that's Section 99(1). But then Section 99(2) has exceptions. I've seen that sometimes referred to as lifting the veil of prescription. So exceptions to the 3-year rule come in, it says in Section 99(2)(a), in the case of an assessment by SARS, the fact that the full amount of tax chargeable was not assessed was due to fraud, misrepresentation, or non-disclosure of material facts. All right, so if SARS is able to show that the full amount of tax payable was not in fact assessed because of fraud, misrepresentation, or non-disclosure of material facts, then the 3-year rule falls away. And then SARS can raise an assessment at any stage. All right. In the case of self-assessment, they have a similar provision in subsection 2B. But we're looking at a SARS assessment here. So in terms of looking at this premium, labeling an investment deposit as a deductible insurance premium in a tax return, the court held constitutes a misrepresentation of the contract's true nature. Well, that was the argument put forward by SARS, and the court found in favor of that. They upheld the SARS argument. So if you have a look at this, the taxpayer had claimed the full amount of that premium as a tax deduction, disclosing it as an insurance premium in their tax return. And it was held that that was a misrepresentation of the contract's true nature. So be very careful of that. Claiming a deduction that you're not entitled to, and on the basis of saying it is X, Y, or Z, can constitute a misrepresentation. If that means that SARS initially doesn't assess the full amount of tax that they would otherwise have assessed because of that misrepresentation, and later it comes to light that there has been a misrepresentation, then the 3-year rule will fall away and SARS can raise this assessment at any time. This should be a major warning to taxpayers in terms of the accuracy of what they put in their tax returns. What is also interesting is that SARS alleged that there had been a non-disclosure of material facts. Now, the non-disclosure of material facts was the non-disclosure of that notional interest of 1,198 Rand. And the High Court supported the taxpayer's argument that that was not a material amount. But when this came before the later court, that was the tax court, when this came to the High Court said, actually, it's not the amount we are considered with, it is the materiality of the fact. It says here, non-disclosure of material facts. Is the fact material? So it says the materiality of a non-disclosed fact, for example, that there's interest being earned there, relates to the relevance to the inquiry of the taxability, regardless of the Rand value. So we might say, oh, but that notional interest, 1,198 Rand, it's such a small amount. It's not material. That certainly couldn't result in the lifting of the prescription veil. Well, the thing is, what is the underlying fact of that? Had you properly disclosed that, it may have alerted SARS to having a better identification of this insurance product. And the fact that you didn't disclose it means that there was a material fact that was not disclosed. So the court said failing to declare even minor income, like this 1198, is material because it would have alerted SARS that the premium was actually an investment. All right, so claiming a deduction that they weren't entitled to, labeling it as an insurance premium, and that is how the taxpayers saw it. It had been sold to them on the basis of being an insurance premium, but the true reality, the court said, was that it wasn't a premium, it was an investment, and so they said there was a misrepresentation. And of course, this non-disclosure of a material fact around the fact that they had earned interest on that amount. As soon as you earn interest on an insurance premium, it's starting to look not like an insurance premium anymore, but more like an investment. And so for that reason, the prescription veil was lifted, and SARS was able to raise the assessment more than 3 years after the original assessment. And then it brings us on to the understatement penalty. Now, when we look at the understatement penalty, so the understatement penalty is levied when there's a shortfall because of certain behaviors of the taxpayer. So that might be that the taxpayer has underdeclared income, overclaimed on deductions, etc. But of course, it relies on what was the behavior that gave rise to that shortfall. Was it because of reasonable care not taken? Was it because of no reasonable grounds? In other words, a misinterpretation of the tax provision? Or could it go all the way through to intentional tax evasion? But right at the beginning of that table that looks at the calculation of the understatement penalty, the first item listed there under behavior is substantial understatement. And a substantial understatement is defined in section 221 as being a case where the prejudice to SARS or the fiscus exceeds the greater of 5% of the tax properly chargeable or R1 million. Okay, so the greater of those amounts, 5% of the tax property chargeable or R1 million. So you could say, well, it's going to be a prejudice. It talks about the prejudice to SARS, so the shortfall on the tax payable. If that exceeds R1 million, it's starting to look like it goes into that category of substantial understatement. And what is interesting is that is determined just objectively on the basis of the amount of the understatement. It's not linked to any behavior of evasion, negligence, failure to take reasonable care and skill, and so on. Okay, it's just simply on the basis of the amount of the understatement. Now, in our taxpayers' case, where they had underclaimed, or they had claimed a tax deduction of 9.6 million, never mind even the interest of 1198 that they hadn't declared. If you take the tax on that, it came to more than R1 million. And so it fell into this category of substantial understatement. And SARS levied 10% being a standard case. It could have been 20% if it was regarded as obstructive or a repeat case, but they just went for the 10%. So on that basis, the question is, had SARS applied the correct penalty? And the court supported SARS treatment in this regard. They said, unlike the higher penalty category, so where there's reasonable care not taken, no reasonable grounds for a tax position, all the way through to intentional tax evasion, those penalty rates go from 25 up to 200%. All right, and this is a 10% on the basis of the magnitude of the understatement. So they say it does not require proof of culpable conduct or intent. It's just simply the magnitude of the understatement. They said claiming a deduction to which you're not entitled constitutes an incorrect statement in a return. And that goes back to the definition of an understatement. So I said here that in the event of an understatement, SARS can, in fact, must levy the understatement penalty. An understatement is defined in section 221 as a prejudice to SARS as a result of one of 5 things: failure to submit a return, an omission from a return, an incorrect statement in a return, if no return is required, failure to pay the correct amount of tax, or 5th, an impermissible avoidance arrangement. So in this case, the court said that there was an incorrect statement in a return. So it was a form of an understatement, which gave rise to prejudice to SARS because there was a shortfall in the amount of tax that had been assessed. If the additional assessment is confirmed and the statutory thresholds are met, the court will confirm the reinstatement of the penalty. All right, because the tax court had found in favor of the taxpayer, so they had reversed the penalty. But here the High Court said we will reinstate the penalty if we come to the conclusion that the premium is not deductible, etc., and that the assessment can be raised more than 3 years after the original assessment, which they did confirm, and therefore the understatement penalty came back into play. So the outcome was that the SARS appeal against the tax court decision was upheld, the 3-year prescription fell away, and the understatement penalties were reinstated. So again, not a very happy outcome for the taxpayer. All right, so far so good. I'm not seeing any questions coming through, so I'm just going to carry on. Let's go on to the third case, which is this transfer pricing case, BASF versus SARS. And it involves Section 31 of the Income Tax Act, which is our transfer pricing provision. But then the real focus of this looks at the tax court rules, and especially you'll see down here, Rule 31, Rule 32. To what extent can SARS amend their Rule 31 statement, and to what extent can the taxpayer amend their Rule 32 statement? You see, this all links to when a matter has gone on appeal. So SARS raised an assessment on the taxpayer here, applying the transfer pricing provisions of Section 31. So they raised an additional assessment. Taxpayer objected to that assessment. The objection was disallowed. They went on to appeal. What happens then when you go on to appeal is that SARS must deliver their Rule 31 statement to the taxpayer within 45 days after delivery of the notice of appeal. Okay, and that Rule 31 statement has to set out SARS grounds for opposing the taxpayer's appeal. And it has to set out a clear and concise statement of the grounds of the disputed assessment, which of the facts or legal grounds in the notice of appeal are admitted and which are opposed by SARS, and the material facts and legal grounds upon which SARS relies in opposing the appeal. So that's what has to go into the SARS Rule 31 statement. And then it says in Rule 31 subpart 3, SARS may include in this statement a new ground of assessment or basis for the partial allowance or disallowance of an objection, unless, so they can include a new ground that hadn't been raised previously, but they can't do that if it constitutes a novation of the whole or the factual or legal basis of the disputed assessment. So if it's a rehashing, a novation of the whole of the factual or legal basis of the disputed assessment, they can't do that. But short of that, they can include in their statement a new ground of assessment. So that's what SARS is allowed to do in terms of Rule 31. Then what has to happen is that the appellant must deliver to SARS a statement of their grounds of appeal within 45 days after they receive the Rule 31 statement from SARS. And in the taxpayer's statement, the Rule 32 statement, they have to set out the grounds on which they are appealing, which of the facts or legal grounds are admitted and which are opposed, and then the material facts and legal grounds upon which the taxpayer relies for their appeal, and opposing the facts or legal grounds in the SARS Rule 31 statement. So each of them is setting up what their arguments are in terms of this dispute. And remember that Rule 31.3 allowed SARS to include a new ground as long as it wasn't an innovation, a complete restatement effectively of the original grounds. As far as the taxpayer is concerned, Rule 32.3 says that the appellant, the taxpayer, may include in their Rule 32 statement a new ground of appeal unless it constitutes a ground of objection that was not previously objected to. Okay, and we saw this in baseline civil contractors that we discussed in the previous update, where it was held that the taxpayer, where they had been part of a partnership and they had included the whole of the whole income in their gross income and then claimed a deduction for the partnership income paid to the partner. Then later on, they said, oh no, hold on a minute. What we actually meant is that we shouldn't have included the whole amount in gross income. There, the court said that the taxpayer had actually raised a new ground of objection that they had not previously raised. So here, the taxpayer was amending its Rule 32 statement. Were they allowed to do that? Was it within the permitted scope of a new ground of appeal in terms of Rule 32.3? And this is what we'll look at as we go along. So the background here is that BASF SA is a manufacturer and distributor of automotive catalysts used to reduce motor vehicle emissions, produced by coating substrates with liquefied platinum group metals and chemicals. All of that could be just reduced to say that they're a manufacturer and they have to buy trading stock. They bought some of their trading stock, the PGMs, from a connected Swiss company, BASF Metals in Zug, a canton in Switzerland. And so here you have a cross-border transaction between connected persons. They're two companies, part of the same group, common shareholders. And then the question is, will Section 31 apply? Well, SARS felt that the trading stock had been sold at a price that did not reflect the true arm's length value, and therefore they said Section 31 must be applied. And so they raised an additional assessment applying Section 31. Now, Section 31, in terms of the current version of Section 31, which has been modified slightly since the year of assessment in which this taxpayer had this issue with SARS. But the current version of Section 31, if you make an adjustment under Section 31, it's actually two adjustments that have to be made. We have a primary adjustment and a secondary adjustment. The primary adjustment is the actual adjustment to taxable income. So if you claim too much of a deduction on the acquisition of trading stock, for argument's sake, then SARS would reverse the excess deduction, adding that back to taxable income, resulting in an additional tax liability. So that's the primary adjustment. And then the secondary adjustment is that the company is deemed to have made a dividend, and that dividend is deemed to be paid 6 months after year end. And if the taxpayer is an individual or a trust, then it's not a deemed dividend, it's a deemed donation. But whether it's a dividend or a donation, you're going to get that extra 20% tax on that leg of the transaction. So when you see a transfer pricing adjustment, it's not just the adjustment to taxable income one has to think about, but it's that secondary adjustment as well. So SARS was saying that BASF SA was paying more than the arm's length price for the acquisition of this trading stock, and they imposed their ability to raise an additional assessment under Section 31(2). I should just say that under the current version of Section 31, it actually contemplates that the taxpayer themselves should make this transfer pricing adjustment. And if they don't do the full adjustment, SARS obviously can do it later on, but that would then result in understatement penalties coming through. Now, SARS' approach, after doing an audit, they concluded that BASF SA had paid too much, as I say, and so they issued an additional assessment of 114 million in tax for the 2011 year. You see how far back this goes. I mean, this is a 2026 case heard in the High Court, and it goes all the way back to 2011. So that's why I say Section 31 has been amended a little bit since then. In those days, Section 31 focused solely on whether prices were above or below arm's length. And I'll give you the current version of Section 31 just now. But SARS, of course, now you have to say, well, if we're saying that the price was above an arm's length price, then what is the arm's length price? And this is where things get really difficult. You can imagine with any kind of valuation, you ask 3 different people to value something. Unless you've got a benchmark like JSE listed shares or something like that, or bond prices. If you have to just do a sort of an open-ended valuation, ask 3 different people, they'll come out with 3 different valuations. So you have to be able to justify your valuation, obviously. And for transfer pricing, there are certain recognized methods of valuation that have been sort of approved by the OECD that are used internationally. One of them is the transactional net margin method, and that's the method that SARS used. And they also used a full cost markup measure to say what should the profit level be if we used kind of arm's length indicators. And they said that BASF's profit level was too low. They said using this full cost markup, BASF's calculation was 0.6%, whereas it should have been kind of at a point of 1. So it fell below the minimum for their comparable set of companies. SARS adjusted their income by increasing their profit margin effectively. The taxpayer objected, and they said SARS is using the wrong basis for calculating the arm's length value. BASF said you should use the comparable uncontrolled price method or transaction method, which is basically saying we've got an external indicator of what those prices are. And they said with platinum group metals, we have that's a traded commodity. You can find those prices. And they said these costs are really pass-through costs in the industry. They carry no profit margin. So SARS was using the wrong methodology, they said. SARS failed to account for extraordinary price increases in rare earth metals that reduced margins. And negotiated prices with their customers, the OEMs, served as a valid market benchmark. So they were saying, in essence, they're saying SARS is using methodology that is inappropriate. They don't really understand the industry. So their arm's length price is not accurate. Now, SARS had consulted a certain expert in order to come up with their estimate of arm's length price. Later on, you'll see that they wanted to introduce 3 new benchmarking studies produced by another expert who introduced a new ground for adjustment called M&E Group Synergies, Multinational Enterprise Group Synergies. Now, this is where SARS wanted to change their ground of assessment. And remember, I said in Rule 31.3, it says that SARS may include a new ground of assessment unless it constitutes a novation of the original ground. Okay, and so the taxpayer was saying SARS can't introduce this new ground now. That is irregular. They can't do that. But SARS was saying, no, this is not a novation. It's just a modification of our original ground of assessment. On the other hand, BASF wanted to amend their Rule 32 statement because they said that when SARS did this adjustment of 114 million, they had missed 77 million that should already have been included. And so BASF wanted to include that in their income data so that they could work that through in terms of their adjustment. So they also wanted to do an adjustment to their Rule 32 statement. Remember, they were allowed to include a new ground of appeal unless it constitutes a ground of objection not raised in the original objection. So if it's just an additional aspect to something that had already been raised, that would be permitted. And so the question was whether each of these sort of additional grounds could be accommodated. And so there, Rule 31.3, I've already read to you. Paragraph 25 of the judgment said that this rule is a prohibitor. SARS is not allowed to include a new ground if it changes or introduces the whole of the legal basis or facts. And it's really important. I think that's a key aspect of this judgment, understanding one's rights and obligations in the dispute resolution process and to push back if SARS is seeking to introduce a ground that constitutes a novation, a restatement of their original statement of assessment. And so here, the court was saying they're not allowed to introduce this new ground if it introduces a whole new set of facts. On the other hand, as far as the taxpayer was concerned, Rule 32.3, I've read that to you, that they may include a new statement unless it constitutes a ground of objection not previously raised in their objection. So the outcome of this particular judgment was that the court said that SARS was actually going too far in amending their Rule 31 statement. They said adding 3 new benchmarks was a fundamental change of case, not just a refinement. And that synergies, adding that to their Rule 31 statement was then ruled legally incompetent under the 2011 version because of the wording of the Act as it was then in terms of Section 31. On the other hand, the court said that BASF was permitted to amend their Rule 32 statement to include the corrected financial data because that was just an extension of something that had already been objected to. They said taxpayers can refine their grounds as long as they are attacking the same disputed amount. And so the High Court ruled that SARS cannot jettison its original audit facts at a late stage in the proceedings. and they held this rule that's Section 31.2, which was the old Section 31.2 as it applied at that time, only allowed adjustments to consideration, the price, not abstract economic benefits. And so BASF's appeal was upheld, overturning the tax court's previous order. So one happy taxpayer out of 3 today. What I do just want to do before we take our break is just to bring us up to speed on the current version of Section 31, because as I say, that case was dealing with Section 31 as it was in 2011. If we look at Section 31, the way it is worded at the moment, the heading of Section 31 is tax payable in respect of international transactions to be based on arm's length principle. All right. Now, what it actually says, and if you go to Section 31.2, it says that where you've got an affected transaction and a person has, a resident basically has derived a tax benefit, because you're talking about South African tax, someone has derived a South African tax benefit, then we would look at the application of Section 31. So what is an affected transaction? It talks about connected persons or associated enterprises. That's an OECD term that was added in a couple of years ago. So connected persons or associated enterprises, residents and non-residents, you've got a cross-border transaction, and any term or condition of the transaction differs from what would have existed had there been independent persons dealing at arm's length. So cross-border transactions between connected persons or associated enterprises, and they've got a non-arm's length aspect in that transaction. And one of the parties derives a tax benefit due to the non-arm's length aspect. So in this particular case, we could say that if we looked at BASF in the current environment, if they were buying trading stock from their other group company, they are connected persons. If they had a non-arm's length element to that transaction and they were paying more than an arm's length price would normally be, then you would end up with a Section 31 adjustment. Okay. But we can also look at this in the context of, let's say, an offshore trust and a South African resident who is a connected person to the offshore trust. Might be a beneficiary or a relative of the beneficiary, maybe the founder of the trust and his children are the beneficiaries of the trust. We've got an offshore trust. Now, if that resident advances a loan to the offshore trust and it's an interest-free loan, we've got a cross-border transaction between connected persons. The interest-free loan would be a non-arm's length aspect. You would not normally find that in a transaction between independent persons dealing at arm's length. So if you have those present as well as a tax benefit. Now, if we could say that this person in South Africa, had they earned income, they would have paid tax. The fact that they're not earning income, they're not paying tax. So there's a tax benefit there. And so that opens the door then to transfer pricing adjustments arising in that kind of scenario as well. So Section 31 can apply not only in companies, but also trusts and for individuals as well. Okay, so as I say, if Section 31 applies and we're saying, right, there is going to be a transfer pricing adjustments, it's not just one adjustment, it's 2. It's a primary adjustment and the secondary adjustment. So you've got the primary adjustment, which reverses the tax benefit, like the inclusion in the income of the resident. If you're saying, well, the arm's length interest would have been R1 million, we're going to add that into the taxable income of the resident. And then that same amount would then be deemed to be, if the resident is a company, it's deemed to be a dividend in specie. If the resident is a person other than a company, it's deemed to be a donation. All right. So if it's a deemed dividend in specie, it means the company carries the dividends tax liability. And you don't get any reduction based on a DTA rate. Okay, it's going to be a 20% dividends tax. And that dividend is deemed to be paid 6 months after year end. And if you're talking about an adjustment like my individual with an offshore trust, etc., there you're going to have the primary adjustment in the individual's taxable income. And then that amount is going to be deemed to be a donation, deemed to be made 6 months after year end. So it would normally carry a 20% donations rate. But of course, if that person's cumulative donations have gone over the 30 million threshold, then it's going to be a 25% rate. Okay, so this application of Section 31 can be quite onerous. And it's something to be careful of whenever you've got cross-border transactions between connected persons. But then, of course, you are looking for whether there's a non-arm's length aspect and whether somebody derives a tax benefit. So if you've met all of those criteria, then yes, Section 31 can apply. And you don't wait for SARS to apply Section 31. You would need to do the adjustment in your taxable income and, of course, do the deemed dividend stroke deemed donation. Otherwise, if you leave it for SARS to find, then there's going to be understatement penalties and so on. Okay. All right. So that brings us to a good point to take a break. And I think we can take a 15-minute break. So if that works, it's 14:20 now. So we'll see you back at 14:35. I'll just add a slide just to make that clear to everybody. And I'll see you at 14:35. Right, I think it is 25 to 3 and time to get going again. I see I had a question coming in from Ati around section 12E, which is your small business corporations, right? And the definition of what constitutes a small business corporation. Now, again, with small business corporations, I think one has to take the view that because it is a concession that is granted and it's intended to be for specifically small businesses that are really held by individuals, that's in essence what the whole idea is. And so Ati is saying, can the purpose of interpretation apply against the 12E exclusion of multiple company shareholdings where there's two companies, one is by law a professional personal liability company and the other is a PTY in a completely separate industry? Seems the relevant paragraph aims to counter splitting operations to stay. Yeah, I mean, that is a huge aspect. And I remember discussions with SARS when this provision was introduced way back in the day, that they were very concerned about splitting operations in order to stay within the limit. And so where they talk about it's a small business corporation is a closed corporation, cooperative, private company, or a personal liability company, etc. If at all times during the year of assessment, all the holders of the shares in that company are natural persons. Okay, so it does make it very clear there. I don't know, would the purpose of interpretation apply against that exclusion? Well, they would use the purpose of interpretation, and my suggestion is that they would interpret it very narrowly, that when it says it can only be held by a natural person, that's really what they're looking at. Okay, let me see if I can now just get back to my slide. It's always a bit of a mission to get this thing to show correctly on the screen. So I'm just going to click back here. Okay, and get back to my presenter view. Right, there we go. Okay, great. Now, just get presenter view. That doesn't seem to want to do that. But anyway, I think you can see my slide okay. That's the main thing. And just to make sure that I'm not talking to myself, yeah, that my audio and video are on. All right, now getting back to the SARS documents, notices, etc. Of course, a big feature at the moment is the 2026 filing season. We are now effectively past the auto assessment phase onto the phase where individuals can now be submitting their tax returns, and I'll get onto some of the SARS updates there in a minute. Then on the VAT side, we're going to be talking about the SARS guide on schools exiting the VAT system. And then on your online traveller declarations to explain who has to submit, etc. And then looking at the SARS draft guide on the taxation of crypto assets, a very interesting guide that they put together there. And I think it's quite insightful in terms of especially this whole issue of capital revenue when it comes to crypto assets. Right, so let's have a look at the 2026 filing season. Now, we did cover the notice around the filing season in the previous update, which I think I did in May. And now SARS has updated quite a number of guides related to this filing season. So you've got your guide on the tax returns for individuals, deceased and insolvent estates, how to submit your return on e-filing, requesting a reduced assessment via e-filing, the guide for provisional tax, the guide to SARS mobile services, and then the SARS Mobi app, and how to submit your individual income tax return using the SARS Mobi app. And keep an eye on the SARS filing season website, because they do keep updating it with various things. If I just have a look at the website over here, let's just bring that across. So just bring that across into my screen that you are able to see. Just bear with me, and I don't know why this is just not playing ball with me today. There we go. Let's just get that across there. Yeah. Okay, so here's the SARS website on the filing season. And of course, they keep it updated with quite a lot of documents, etc. And they've got an actual web page that you can have a look at as well. All right. And of course, please, please, please warn your clients around scams. It's just terrible to see how many people get scammed, and especially when it's under the premise of SARS refunds, etc. And then, of course, SARS has quite a lot of videos that you may want to disseminate to your clients as well that can be useful. I haven't personally looked at all of these videos, but I've looked at some of the SARS videos, and some of them are really quite helpful. So have a look at this. Keep an eye on the SARS filing season just to stay abreast with any developments there. And then just to go back to my slides. Of course, the key dates for submission, we've had the auto assessments. We're now into the non-provisionals who have to submit by the 23rd of October. Provisional taxpayers by the 22nd of January next year. And I'm going to talk in a moment about the issue around provisional taxpayers, because I think one of the big problems we've had in previous years is where people think that they are provisional taxpayers, and so they give themselves the extended period for submission of the tax returns. SARS takes a different view and then says they should have submitted by, let's say, 23rd of October. They end up with the late submission non-compliance penalties, which can add up to quite a bit when you think that those penalties are levied on a month-by-month basis. And so if that accumulates over time, it can end up being a rather nasty penalty. And if you only find out about that, a few months down the line, and it can be difficult to get those penalties reversed. Trusts, on the other hand, the filing season, SARS says, will open on the 19th of September and go through trusts, any trust, whether the trust is a provisional or a non-provisional taxpayer. They have until the 22nd of January next year to submit. Now, remember that trusts, the trustees on behalf of the trusts have to submit their IT3T returns. That's the return listing any distributions by the trust, and including loan accounts, etc. That has to be submitted to SARS by the end of September. So that deadline is still end of September. But SARS has said from the 19th of September, you would be able to access trust tax returns through e-filing. Some people have indicated that they can already access their trust tax returns, but I would suggest that it's probably not a great idea to start filling out those tax returns just yet. I'm just concerned that you go to all the trouble filling these things out, and then SARS replaces that with updated returns on the 19th of September, and then you've lost all of your data. You have to go back and start all over again. So yes, by all means, of course, get the annual financial statements done, get all the financial data ready, but I would probably wait until the 19th of September before you start trying to submit information on your trust tax returns. Okay, but you do have until the end of January next year. Right, so that's on the filing season. But linked to that, this whole question of who exactly is a provisional taxpayer. I think a lot of people still work under the old idea of provisional taxpayer. And if you remember, back in the day, you used to be registered as a provisional taxpayer. So a lot of people still use that argument. But I was registered as a provisional taxpayer back in 1983 or whatever the case might be. Well, it doesn't really matter how long ago you may have been registered or not registered as a provisional taxpayer. The way that the concept of provisional taxpayer works now is that it works on a year-by-year basis. And each year, the person would have to assess and work out whether they are a provisional taxpayer for that year. And of course, you can't wait until the end of the year to work this out, because if you are a provisional taxpayer, then you have to submit your first and second provisional returns. Think about the third return. But then, of course, a big aspect as well is this deadline for submission of your tax return. So if we are saying, what would my deadline for submission be? Would it be October or would it be January? This relates to the 2026 year of assessment. So I have to say for this person, and we take it one person at a time. I know this can be extremely difficult if you've got hundreds of clients, but hopefully many of them are easy to categorize. But with the more difficult ones, you literally have to look person by person and say, for this 2026 year of assessment, was this person a provisional taxpayer? That links to the definition of a provisional taxpayer in paragraph 1 of the 4th schedule, which tells us that a person other than a company, so who is a provisional taxpayer? If it's a person other than a company, it's a person who earns income by way of either remuneration from an unregistered employer. All right, so it could be an employer maybe based overseas or whatever. If they haven't registered under paragraph 15, then you're earning remuneration from from someone who's not registered as an employer, it means you're not paying employees tax. And then it's up to the taxpayer to recognize that they are a provisional taxpayer and they have to pay provisional tax. Or any amount of income other than remuneration or an allowance or advance contemplated in Section 8.1, travel allowance, etc. Okay, so if you're earning any income other than remuneration, it's indicating that you would be a provisional taxpayer. We're talking individuals here. But then they have certain exclusions, all right? And when we're looking at somebody who derives no income from carrying on a business, there's some exclusion. So the flip side of that is that if you have an individual who is deriving any income from carrying on a business, their own business, other than salary earning, remuneration earning work. So if they're carrying on their own business and they're getting income from carrying on a business, they would be a provisional taxpayer. Now, it's really important to notice the wording here, that it talks about not deriving any income from carrying on a business. It doesn't say trade, it says business. Now, trade is a defined term, and it includes remuneration, etc. And it also includes the letting of fixed property. That's all included in the definition of trade, which you find in Section 1. In fact, I'm just going to go there and just have a quick rewording of that. So if we look at the definition of trade, trade includes every profession, trade, business, it includes a business, employment, calling, occupation, venture, including the letting of any property and the use of intellectual property and so on. All right, so trade is defined. Business is not actually defined, but our common law understanding and our common language understanding of business is when you are actively working at making a profit. So you might be buying and selling things, or you might be providing a service. That would be carrying on a business, okay? And a business falls within, remember when I read trade here, it said it includes every profession, trade, business. So trade includes a business, okay? Now, the point I'm making here is that a business requires a kind of an active pursuit of earning a profit. Trade includes the letting of property. Now, the letting of property, you could be letting property as an investment, just holding it as an investment, and you've got a letting agent who's letting it out. You're not really actively working at earning that rental income. That would be a trade. But if you're actively working at earning that rental income, then that would be a business. All right. So one needs to understand this, because when we look at this, we say if you're working on a business and you're earning income from carrying on a business, any income from carrying on a business, then you're a provisional taxpayer. But you might be holding property and renting that out just as an investment and not as a business, more as a passive investment. And then that would be a trade, yes, but you're not carrying on a business. Now, if you carry on with this, if you've got no income from carrying on a business as such, and either your taxable income falls below the tax threshold for the year, or, in other words, it's above the tax threshold, but then if you look at the taxable income from your investment income, and it specifically lists here interest, both local and foreign, dividends, local and foreign, rental from the letting of fixed property. Now, if you were earning rental as a business, you would be coming into this top category where you would be a provisional taxpayer. We're saying you're not carrying on a business, but here you're earning rental from the letting of fixed property. That would be where it's as a passive investment, okay? And then remuneration from an unregistered employer. And it says, if your taxable income from all of these sources combined does not exceed 30,000. So this is somebody, they're not carrying on a business. They're not earning income from carrying on a business. They might earn remuneration. They have got investment income, but the taxable income from all of their investment income does not exceed 30,000 Rand. Then they are not a provisional taxpayer for that year. And so you can see how this could possibly change from year to year. Maybe last year, their taxable income from investment income did exceed 30,000, all right? Then they were a provisional taxpayer because they got income other than remuneration. But now this year, maybe they have maintenance costs on their rental property. And so it brings down their taxable income from rental, and maybe that results in the combined taxable income being below 30,000 here. They're not carrying on business, but because this goes below 30,000, it could be that this year they're not a provisional taxpayer. So this can be fairly complex, and unfortunately, we don't see too much assistance from SARS. I mean, it might be nice if they just indicated to us, whether this person was a provisional taxpayer or not, but they don't really provide any assistance here. You've got to figure this out for yourself on a year-by-year basis, noticing deceased estates are not provisional taxpayers. Let's look at this example over here. Let's say that you've got a person who's got salary income of 1.85 million, and they've got quite a lot of investment income, interest, dividends, and foreign dividends. They're not carrying on a business as such, all right? So they've got no income from carrying on a business, but they have got a taxable capital gain. All right, well, let's just address this capital gain. A taxable capital gain in itself does not make you a provisional taxpayer. Nowhere in paragraph 1 of the 4th schedule does it talk about taxable capital gains. It says you've got income other than remuneration. A taxable capital gain, if you look at the format of the taxable income calculation, you've got gross income minus exempt income gives you income. Then you've got your deductions, and then way down at the bottom, you add in through section 26A, you add in your taxable capital gain. That is not another form of income. It's an inclusion in taxable income. This is where it's important to really remember these specifics with tax, okay? So this doesn't make the person a provisional taxpayer. Let's look at this investment income. The interest income, he gets his local interest exemption of 23,800. So taxable income from that interest is 24,200. Interest is fully, dividends, local dividends, fully exempt, so taxable income is 0. Foreign dividends, in this case, let's say that they are listed shares, and so there's a full exemption under section 10B2, and so taxable income from foreign dividends is 0. So if we take the combination of all of this, going back to what it says over here, the taxable income from all of the following: interest, dividends, rental, and remuneration from an unregistered employer. Taxable income. What is the taxable income from all of this? 24,200. That is less than 30,000. And so we've got a person, yes, they do earn income other than remuneration, but they are not carrying on a business. They get no income from carrying on a business, and taxable income from this combination of investment income, let's call it that, does not exceed 30,000 Rand. So that person is not a provisional taxpayer. And just by the way, if their taxable income had been below the tax threshold for the year, they would not be a provisional taxpayer. But this person is way above the tax threshold, but he is not a provisional taxpayer. So just to reiterate, that provisional taxpayer status must be considered every year. So if we were looking at this person for, let's say, 25, 26, or indeed 26, 27, but let's say for the 2026 year of assessment, not a provisional taxpayer, so his tax return would have to be in by this date of the 23rd of October, 2026. All right, and if he didn't get his tax return in by that date, he's going to end up with non-compliance penalties, the failure to submit penalty in terms of the Tax Administration Act. So it's really important to consider this. Obviously, if you've got people who are carrying on a business, getting income from carrying on their own business as a sole trader, great, they are provisional taxpayers straight away. But this area where they're not deriving income from carrying on a business, but they've got investment income, that's where you have to have a look at this 30,000 to see whether the threshold has been exceeded or not. And just to reiterate that this taxable capital gain does not make the person a provisional taxpayer. Now, that's an interesting one. A lot of people really stumble on that. They say, no, but hold on a minute. If you're a provisional taxpayer, when you submit your estimates of taxable income, you have to include your taxable capital gain. Yes, if you're a provisional taxpayer. This person was not a provisional taxpayer for this year. Therefore, they did not have to submit any IRP6s. They didn't have to make any provisional payments. If they did make provisional payments, yeah, that's just counted as an advance payment towards their final tax liability. But they were not provisional taxpayers as defined. So they didn't have to submit the IRP6. All right. So if they just stuck to the rules, this taxable capital gain would just be assessed at the end of the year when they submit their final income tax return and they get assessed based on their total taxable income. And then, yes, of course, they would have to pay in tax because they've got interest income and they've got the taxable capital gain. And they would only have been paying tax based on their remuneration. So there'll be an additional amount of tax payable on assessment. But they are not a provisional taxpayer. Okay, so be careful of that because it really makes a difference in terms of the submission date. And every year there seem to be hundreds of people who are caught short based on the fact that they think they are provisional taxpayers, so they only submit in January, and then they end up with the late submission penalty. All right, so I think that's it. Oh, yes, I thought I might have a question on that. Let's have a look. If a taxpayer only receives a distribution from a trust, e.g. taxable interest exceeding 30,000, are they a provisional taxpayer? Well, it's okay, so let's think about that. The person is earning income other than remuneration, and their taxable income from interest, you're saying taxable interest, all right? So that's after taking off any exemption, it exceeds 30,000, then yes, that person would be a provisional taxpayer. Okay, because they're not subject to that exemption that I spoke about just now. All right, so just going back to this aspect here, to answer that question, we'd say, right, they are earning income other than remuneration. And if we look at the exclusion, they're not carrying on a business, but their taxable income from interest exceeds 30,000 because flow-through principle, you're getting interest from the trust, it's still interest. If that's after taking off your local interest exemption, it's still above 30,000, then you would be a provisional taxpayer for that year. All right, so it's not based on the fact that you're a beneficiary of a trust, it's based on the level of your income for that year. Okay, let me see if there's any other questions before I move on. I think that is it. Okay, so to get to the VAT side of things for today, if you remember last year when we did the year-end update, I would have covered this, that there was the amendment to Section 12 dealing with schools. So Section 12 of the VAT Act deals with exempt supplies, and schools are covered under educational services. And Section 12H4 of the VAT Act was amended. Now, it was amended in terms of, I say, last year's legislation, but that legislation was only promulgated on the 1st of April 2026, so it becomes a bit confusing. So it's referred to as the 2026 Taxation Laws Amendment Act, but it's really the amendments that came through from the 2025 budget speech. It came through that whole process last year, and that's why we would have covered this in last year's year-end tax update. So in terms of this amendment to Section 12H, subparagraph 4, it tells us that the supply of any goods or services by a school registered or provisionally registered under the South African Schools Act, those supplies are exempt, other than supplies made in respect of welfare activities carried on by a welfare organization, as confirmed by the Commissioner. All right, so this amendment basically said from 1st of January 2026, all supplies of goods or services made by a registered school are exempt from VAT. So prior to this date, there may have been some schools. Now, obviously, school fees would have been an exempt supply, but then some of the schools might have charged for other things as well. Some of them might have rented out facilities. They might have rented out sporting fields. They might have derived income from all sorts of different things. They might have run a tuck shop. And they might have sold secondhand school uniforms. And so some of those would have constituted taxable supplies under the VAT Act. So schools then ended up in a situation where they had mixed supplies. And of course, that got quite complex in terms of you can only claim input tax on goods and services acquired to the extent to which they will be used to make taxable supplies. So you had to apportion your input tax, and it all became quite complex. And so this change that came through was designed to provide greater legal certainty and relieve schools, this is what SARS explaining the change, relieve schools of the administrative burden associated with maintaining a VAT registration. So as part of the explanatory memorandum last year, the draft explanatory memorandum, SARS explained that many schools had come forward and asked if SARS could please change the VAT legislation to take schools out of the VAT system altogether. And so that their amendment was in response to those requests. Now, as a result of this amendment, and it has been made complicated by virtue of the fact that the amendment is effective from 1 January 2026, but the Act was only promulgated on 1 April 2026. Nonetheless, the effective date stays the same. But SARS is only releasing this guide now in July 2026. And so this is all quite sort of long after the 1st of January. Now, some schools might still have been charging VAT. They should not be charging VAT, but perhaps they have been charging VAT. So the reference guide does address that as well. But it focuses really mainly on what happens when schools deregister. So because schools are no longer making any taxable supplies, they really are not vendors anymore. All right, so they are required to deregister, but SARS would not automatically deregister them. They have to go and apply for deregistration at SARS. Now, when you apply for the deregistration, SARS is going to do an audit to see whether you have paid the exit tax, the exit VAT that arises on deregistration. That's effectively a clawback of any input tax that you previously claimed on assets that are still on hand at the time of deregistration. So let's assume you had a school that was running a tuck shop, and they were registered as vendor because maybe there were other things they were doing as well that were carrying VAT. But if you look at the tuck shop, they're buying and selling goods, basically, okay? Now, when they bought their trading stock, they claimed input tax on the basis that they were going to charge VAT on the sale of all of that trading stock. Whatever trading stock they had on hand at the end of December when they deregistered, they've effectively got to reverse that input tax. And that's what comes through with this final exit VAT. Now, it's not just trading stock, it's also your capital assets. So if they had bought land that was now being rented out to generate taxable supplies, or it was prior to the 1st of January 26, it was now it would be an exempt supply. But if they were charging rental on that land, and so when they bought the land, they claimed the notional input tax on the acquisition of the land, now that land is still on hand, and now they have the exit VAT on that land. They've got to effectively reverse the VAT that they initially claimed. All right, and this links to the fact that the schools are no longer carrying on a taxable enterprise, so they have to apply for deregistration, and that will trigger this exit VAT. Now, the exit VAT comes through Section 8.2 of the VAT Act, and that creates a deemed supply of all enterprise assets held by the school immediately before it ceases to be a vendor on the 31st of December 2025. The primary purpose of the exit VAT is to claw back input tax that the school previously deducted on assets that it still owns at the end of December. So the enterprise assets have to be identified, and that's basically any good or right that was used for taxable activities, like a tuck shop or uniform shop, maybe even land and buildings, it just depends. But the issue is that you claimed VAT on the acquisition of that asset. So it's not talking about services, all right? It's talking about assets that are still on hand when the school deregisters. Assets on which input tax was claimed. So assets that were used exclusively for exempt educational services like school desks and chairs, etc. That would be used for educational services, which are exempt, so you would get no input tax on the acquisition of those assets. So those would not be enterprise assets. They fall outside the scope of the exit VAT calculation. But the other assets on which the school claimed input tax, which are enterprise assets, identify the asset and then work out the lower of cost, original cost on acquisition, or open market value. Now, open market value, in terms of the VAT Act, by definition, includes VAT. So if we're doing a comparison, we must take cost inclusive of VAT, even if VAT had been claimed, so that we're comparing like with like, all right? Take the lower of the two, and then you're going to multiply that by the tax fraction, 15 over 115, because you're saying the amount that I'm working with includes VAT. So to work out the output VAT, apply the tax fraction, and that gives you the VAT that you have to pay across to SARS. All right, so it does give this beneficial aspect for schools because it ensures they pay the VAT on the depreciated value of older equipment rather than original purchase price. So if you've got a depreciating asset, you're going to work with a lower value, lower of cost or open market value, so it's the depreciated value. If you've got something like land and buildings which have appreciated in value, you're going to work with cost. Okay, so it's the lower of cost or current open market value. What is the market value on the 31st of December 2025? So if that market value is higher than cost, then you're going to work with cost. Cost including VAT, because you're then going to apply the tax fraction. Now, the guide does recognize that there's complexities with fixed property and improvements, because if you have public schools occupying state land, typically that's a zero cost right of occupation by law. So no exit VAT would arise on the land. I mean, they're just occupying the state land. And the question always is, did I claim input tax on the acquisition of this asset? So in this case, you would not have claimed input tax, so there'll be no exit VAT. It's not an enterprise asset. But if the school used its own fund to make permanent improvements, like they bought sports fields or new buildings which they're renting out as venue hire, wedding venues or whatever the case might be, and if they claimed VAT, that's the key thing, they claimed VAT on those costs, then you've got to reverse that VAT, and those assets will be enterprise assets. You take the lower of cost or current market value on the 31st of December 25, that's going to be the value that you use, the deemed consideration on that deemed supply. Now, some key exclusions from this exit VAT: items where input tax was denied at the time of purchase, like if you bought a motor car, right? No one can claim VAT on a motor car unless you're dealing in motor cars, which a school would not be. General entertainment expenses, all right? So you buy a microwave or a set of teacups for the staff tea room, that's entertainment expenses. You wouldn't have been able to claim input tax on the acquisition, and so there would be no exit tax on that. But if you bought trading stock, or you bought things, a microwave for the tuck shop, of course, that's a different matter. That's equivalent to a shop, a retail operation. And there, although it's entertainment, it's within a part of the business supplying entertainment. And so there you would have claimed the input tax, and now you would have to list that as an enterprise asset and raise the output tax. Donated goods or assets acquired for no consideration are also effectively excluded because their cost to the school is zero. So the key thing always is, hopefully you've got a fixed asset register, and on each of those assets, you have to identify what are the assets that were on hand at the end of December 2025. And then, was input tax claimed on the acquisition of those assets? And if the answer is yes, then that is an enterprise asset on which you would have to look at paying the output tax. Now, there is also another aspect that, let's say on the acquisition of this asset, you had not claimed the full input tax. Maybe the vendor had said, or the school had said, they're going to use this asset 20% for taxable supplies and 80% for educational services, which is an exempt supply. So they only claimed 20% of the input tax on acquisition. That same asset, when the school deregisters, it's a deemed supply of the whole amount of the asset, the full cost or market value, whichever is the lower. So you've got a full supply of the asset, but now on acquisition, you only claim 20% of the input tax. So now under 1638, you can get an adjustment for the other 80% of input tax you now claim, and you raise the full amount of output tax. Okay, so you can make this adjustment when you do the exit VAT calculation. And the net effect is that schools generally only repay the specific VAT benefit they actually received while they were registered vendors. Okay, because if you took just a very simple example, if you output VAT, let's say the output, well, put it this way. Let's say that the lower of cost to market value on the 31st of December is 1,150 Rand. So the output VAT on that is 150 Rand, okay? When you acquired that asset, you paid 150 Rand VAT, but you only claimed 20%. But now you're going to claim the other 80% of the VAT against that 150 output VAT. So the net amount of VAT is what you're going to pay over to SARS. Okay, and then this aspect about timing. So they talk about 2026 being a gap year. So during this 2026 year, remember that the amendment became effective from 1 January 2026. For the whole of the 2026 year, schools no longer make any taxable supplies. So they must be submitting nil returns. They haven't yet deregistered, so they have to still submit returns, but they must be nil returns, and they must not be charging VAT on anything. If they incorrectly charge VAT, then they must either issue credit notes and refund the tax to the recipients, or else pay the VAT across to SARS, but they can't claim any input tax. All right. So the correct way of doing this would be to reverse the VAT, pay it back to your customers, and issue credit notes and refund the tax to the recipients before SARS will process any related rectifications. Okay. Otherwise, you have to pay the VAT across to SARS if you say it's just impossible to try and process these credit notes. And for this whole period of 2026, then, there's no payments that have to be made. When you work out your exit VAT on deregistration, that has to be paid starting from 1 January 2027, and you can apply to pay it in 12 equal monthly installments. And those payments would be interest-free. So for the whole of 2027, you've got an interest-free scenario, no interest, no penalties, as long as the school agrees to the repayment schedule and provides the required payment arrangement letter. All right, so all of this that I've covered is a summary of what is in the SARS guide, and I've given you a link to that SARS guide. Well, Yusuf, the detailed definition of a school is a school that is registered under the Schools Act. That's what it tells us in section 12H. Okay, so when you talk about a school, it's a school that is registered under the South African Schools Act or provisionally registered. Okay, so this guide, let me just go back now and just click on this guide. So you can see it on my screen here. I must just scroll down to get to the point where we've got the actual guide. Sorry, just bear with me. There we go. Schools exiting the VAT system. Okay, so when we look at this guide that SARS has issued, and you'll see here that it was issued 17th of June 2026. It is just a guide, by the way. They make the point that it's not an official publication, not a binding general ruling. It doesn't establish practice generally prevailing. It's just to be used as a guide and not as a legal reference. Okay, but it does go through, and let me just show you the contents here. So it talks about this whole aspect of the enterprise asset. What is an enterprise asset? The section 8.2 exit VAT, the lower of cost to market value. What does that mean? All of those things are covered on my slides. This aspect of fixed property with, state schools, might be using state land, but they wouldn't have claimed input tax on any sort of acquisition there. So there wouldn't be any output tax. But if you take a school that has purchased land and buildings to be used as part of their enterprise, they might have claimed input tax. Then they would have to raise the output tax on that. Key message for schools, let's just go and have a look at that. The starting point is to ask, did the school deduct VAT? Partly or wholly on this item because it was used for taxable supplies. That is the absolute key for each asset. As I mentioned, you take your asset register, you go through, did you claim VAT on the acquisition of that asset? If yes, then generally you're probably going to have to think about the 8.2 exit VAT on that. If no, it's going to fall outside the exit VAT calculation. And then you go through and work out the actual exit VAT calculation on each particular asset. Okay. All right. So then it talks about ceasing to be a vendor, and then various legal terms of goods, fixed property, etc. Entertainment, motor cars, input tax not paid within 12 months. Remember, the rule in the VAT Act is that if you purchase goods on credit, this is for anybody now, you purchase goods on credit and you claim the input tax based on the fact that you have a valid tax invoice, but you haven't actually paid for those goods. If you don't pay within 12 months, you have to reverse the input tax. Okay, that's in terms of Section 22(3) of the VAT Act. But now, of course, if you are in a situation where you are now supplying those goods under this exit VAT, oh, what's happened to there we go. If you're supplying the goods under the exit VAT, then you would have to have the output tax on the exit VAT, and then you claw back the input tax. So these are just some of the complexities that may arise in various situations. Just going back to some of the other things that are covered here, donated goods and services, and then they talk about input tax and deductions where there was apportionment. So if you apportioned your input tax on acquisition, remember that when you have this deemed supply on deregistration, you deem to supply the whole asset. Okay, so you've got to raise the full output tax, and then you do that Section 16(3)(h) adjustment I spoke about earlier for the balance of the input tax. And then they have miscellaneous issues, transitional rules, welfare organizations, and so on. Okay, so there's quite a lot that is covered there on the SARS guide. And so if you are dealing with schools, please be aware of this. And please do make sure that the schools are no longer charging VAT on anything. There should have been no VAT charged on anything since the 1st of January 2026. Okay, I hope that has answered some of the questions on the deregistration of schools and the VAT implications. Then the next SARS document I wanted to cover was this online traveller declarations. So from the 1st of July 26, anybody entering or leaving South Africa has to actually go online onto the SARS website and fill out these traveller declarations. Now, there would be hard copies made available, but it's probably going to cause quite a delay when you try and clear customs. So it would facilitate probably a quicker transition if you just went online and filled out these declarations before you travel. Okay, so if you're going out, you're coming in, make sure that you fill out these declarations. And maybe I should just click on there just to show you what it's telling you here. What is changing, it explains that who has to submit. In general, any person entering or leaving South Africa by air, land, or sea, or rail must submit the declaration, including South African citizens, residents, and foreign travelers. And then if you've got children with you, each person has to submit. So you have a parent, legal guardian, caretaker, or assisting person complete the declaration on behalf of a minor or a person who can't complete it themselves. Are there any exclusions? Well, people who are transiting through South Africa and they don't actually come into the country, they would not have to submit the declaration, but that's a very limited exclusion. Why are they doing it? They say to make it easier for travelers to comply, and also for SARS to identify items coming in or going out of the country. And then just scrolling down here a little bit, what is the sort of customs limit that one talks to? It talks about cash exceeding 100,000 Rand. Travelers are permitted to carry a maximum of 100,000 Rand in or out of South Africa in foreign or local currency without prior approval, but you still need to declare this on your form. What duty-free allowances apply? Goods up to 5,000, personal items, additional goods might be subject to VAT and customs duty. And if the value exceeds 25,000, then you've got normal customs duty and VAT. It does just make it a little bit more onerous, perhaps, or feels more onerous having to submit this form. But SARS has indicated that anybody coming into South Africa or going out of South Africa has to submit this form. Okay. Then I think this is the last item, is the draft guide. Oh, second last item. Maybe I'll just do this other item and then come back to the draft guide. The submission and processing of AA88 third-party appointment notices. So this is when SARS notifies his employer that they've got a garnishee order on the person's salary. They want to recover tax. And so they have updated their guide for employers to help them with how to deal with this notification from SARS that they've been appointed as a third party. Okay, so if you are involved in that process at all, have a look at this guide that SARS has put out. But then I want to go back to the draft guide on the taxation of crypto assets. Now, this guide, the draft guide, SARS has just recently put out. Let's just get that up onto the screen here. You'll see here that this draft guide was issued in July, and it's open for comment until 21st of August. So it is still open for comment. I'm personally not an expert on crypto, so I can only speak to the main principles in this guide. But if you are an expert on crypto and you notice something in here that seems inaccurate or untoward, then I would really suggest that you submit comments through to SAICA or your professional body so that they can submit something through to SARS. It is important that we get this guide as accurate as possible, dealing with something as prevalent and controversial as crypto. Colin has just asked, does the travelers form specifically talk about used goods? I'm not aware of that, Colin, but you can go onto the SARS website and have a look at the form to see what exactly what exactly it says, the wording that it uses. Go on and have a look at the form. Yeah. Okay, so again, this guide, when it is released as a guide, it'll not be an official publication. It doesn't create practice generally prevailing and should not be used as legal reference. Okay, but you can use it for your own guidance. And you can see it's a long guide, 50 pages, similar to that guide for schools exiting the VAT system. This 50-page guide on crypto, it talks about the whole idea of what are crypto assets, how they're defined in the tax legislation. And crypto assets, many people think of as currency, but for tax purposes, they're not regarded as currency. They are regarded as a financial instrument, a type of asset. In fact, if you look at Section 1 of the Income Tax Act and you look at the definition of financial instrument, it says it includes loan, advance, etc. And item F, it says any crypto asset. So it specifically is included in the definition of a financial instrument, but it's not a share in a company or something like that, but it is a financial instrument. Okay, and so it is a type of asset. Now, having said that, we could say, well, is this a capital asset or is it trading stock? Well, that is going to be on a very much a taxpayer by a taxpayer basis, and it's going to depend very much on the surrounding circumstances. And SARS goes into a lot of discussion around this capital or revenue nature of crypto assets. Let's just have a look at that. It says here, one of the most important tax principles is this distinction between capital or revenue. We have to go back to the normal old principles. Now, crypto is very much a 21st century phenomenon, but we are using tax case principles that go back sometimes 100 years. If you go back even more, go back to the old Natal Estates case, the Berea West Estates, all those good old cases that you covered in your university studies when you studied VAT. VAT and income tax, but looking at this distinction of capital versus revenue. And so it's a difficult one. As they say, there's no single infallible test of invariable application, and there's no safe harbor for crypto. We have Section 9 Cap C that applies in the Income Tax Act, but that applies to shares. So it talks about a share dealer who holds onto shares for longer than 3 years. Then the proceeds are deemed to be capital. So that it shifts from being trading stock to a capital asset when you've held the shares for 3 years. But that only applies to shares. It doesn't apply to crypto. So we have no safe harbor as far as crypto is concerned. So it really comes back to the onus on the taxpayer under Section 102 of the Tax Administration Act. And that means you have to look at all of the facts and circumstances that relate and underpin that situation. Well, my computer's having a bit of indigestion here. Let me just go back to my slides and go back into that guide. See if I can get back to it. All right. Yeah, so we have to go back to all of those different tests, okay? And the key test, the golden rule, if you remember that, capital versus revenue, the golden rule of intention. What was the intention of the taxpayer on acquisition? What was the intention during the holding period? And what was the intention on sale? And that could be supported by what was the reason for selling the asset. Now, it's possible that you might have an intention of investment, holding value, and you might change your intention. Remember the whole aspect of crossing over, crossing the Rubicon, crossing over to holding the asset as trading stock. So it's possible you can have a change of intention. And so it's all going to depend on the facts and circumstances of the particular case. All right, so they talk here about the Capstone case, which that was a judgment from 2016. It's about the most recent judgment on capital revenue. And they say, apart from the stated intention of the taxpayer, a number of factors must be considered. So you do look at factors as well. You got the ipse dixit of the taxpayer, what they say, but you measure that up against the external factors. All right. How long did they hold the asset? How did they finance the asset? What was their financial situation? What were the other transactions? How many transactions have they been entered into? All of these kinds of things would help to create an impression of whether this is capital or revenue. So period of holding, but none of them on their own can stand. You look at all of these factors, and the factors together would give an indication to support or go against the taxpayer's stated intention. Here we go with the Natal Estates case, all right? That's going back to 1975, 50 years ago. And we're bringing out principles from the Natal Estates case. In deciding whether it's capital or revenue, you must think one's way through all of the particular facts of each case, etc., etc. All right, so it becomes very difficult. So the factors to be considered, the taxpayer's ipse dixit, but then you compare that and evaluate that against the external factors, conduct and activities of the taxpayer in relation to crypto, the nature of the business, the frequency of transactions, the length of time the asset was held, etc. The fact that you're not actually getting a return on crypto until you actually sell it. And they make the point that one could then compare that a bit, perhaps, with the Krugerrand cases, because Krugerrand's also, there's no return until you sell the item. Now, if we look at the case law on Krugerrand's, it's a bit of a mixed bag, and it certainly doesn't give us anything conclusive. They've cited 6 cases here, and we've got what, 1, 2, 3, 4 of them, the outcome was capital, and 2, the outcome was revenue. And if you look at the holding period, it varies quite substantially, so that is by no means conclusive. But you look at intention on acquisition, inevitably it's always to hold value, to buy it as an investment, etc. But then look at the reason for selling, and that might indicate that there's been a change of intention. So where it was held to be capital, the reason for selling was to assist family members. Here, after repeated warnings that the gold price was too high and would fall, this capital item to finance re-roofing of the house. And this capital item, they needed the money to buy a car for his wife. All right, so, these are all quite antiquated. These cases are all old, going back 1981, 1991, etc. But the essence of these cases and the principles coming out of these cases will still be relevant in today's environment in deciding whether a person is dealing with their crypto as capital assets or trading stock. All right, so very important to look at that and consider that there can be this change of intention. There can be mixed intentions, more than one intention. Then you're looking at the dominant intention. This all becomes very legalistic. And if you do have to make this decision, it would be important to read through this guide carefully and consider the various cases that they refer to. And maybe there are others, okay? This is not necessarily 100% comprehensive. But if you are dealing in crypto as trading stock, then of course your acquisition costs are allowed as a deduction, and then you've got to deal with your opening stock, closing stock every year. deduction of opening stock, add back of closing stock. But when we add back closing stock, there is a provision in 22(1) that talks about the lower of cost, or you can reduce that by any amount the commissioner considers reasonable, represents damage or deterioration, etc. But that write-down does not apply to crypto. So because crypto is a financial instrument, you would have to hold it and keep it at the original cost price. Here it states that over here. Crypto assets are financial instruments. As a result, they are included in closing stock at cost price. Even if the value has diminished, you don't write it down, you hold it at cost price. And if you end up selling your crypto at a loss, you end up with an assessed loss, well, you might be subject to Section 20A, all right, the ring fencing of assessed losses. Remember that in terms of the recent amendments, Section 20A does not only apply to people who have taxable income at the maximum marginal tax rate, it now kicks in at a much lower level. So it's actually kicking in now for people who are subject to taxable income. I think it's just over 673,000. All right, so crypto assets or the dealing in crypto assets is regarded as a suspect trade in Section 20A(2)(b. All right. And that means that if your taxable income is in the threshold where it's subject to Section 20A, then losses on dealing in crypto assets would be ring fenced. Okay. And then they're dealing with short-term disposals, etc. And then they go on to talk here about uses of crypto assets and associated income tax consequences. So if you sell your assets in exchange for rands, the fiat currency, the currency issued by a government, it gives a whole lot of examples there. If you exchange your crypto assets, what would the tax implications be, and so on. So yeah, as I say, this is an extremely lengthy guide. It looks at lots of different things. Services rendered by an employer in exchange for crypto, or crypto granted as a benefit or advantage of employment, how to deal with that situation. Arbitrage, crypto arbitrage, and it's got a lot of different examples here. Partnerships, earning crypto assets through staking. This is maybe, if you don't know about crypto, you can read all these things and expand your knowledge on this, all right? How do you deal with that? Proof of stake and subsequent sale. They've got examples there. Decentralized finance, DeFi, initial coin offerings, airdrops, hard forks, all these wonderful 21st century terms. Receipt of an airdropped crypto asset. Yeah, so I think this looks pretty comprehensive, but as I say, I'm not a crypto expert. So if you are a crypto expert, please have a look at this guide and just make sure that everything is in there that needs to be in there and that it's accurate. Again, it talks about things like donations tax. If you donate, you're looking at the value of asset on the date of donation. And then compliance and documentation. So your income tax return must be completed properly. So if you're regarding your crypto as a capital asset, then it's probably going to be something that's going to be listed as on your statement of assets and liabilities. Well, even if it's trading stock, of course, it'll be listed there. But you would be making disclosure on your tax return accordingly. Trading stock or investment asset, etc. Your provisional tax, think about whether you're a provisional taxpayer. We dealt with that earlier. And your record keeping, to make sure that you keep all your records. And this seems to be one of the biggest challenges with crypto, is to have the proper records. And just always be thinking about, if SARS raises a query 3, 5, 10 years down the line, am I going to have the necessary documentation to support my tax treatment of that crypto? All right. Yeah, so very interesting guide. And remember the crypto asset framework, I spoke about this back in May, that crypto asset service providers have to report to SARS under the reporting framework. Individuals don't have to report, but individuals have to make sure that they fill out their tax returns correctly to make proper declaration of their crypto. All right, so I hope that has given you some indication of what SARS is thinking around the whole idea of crypto assets and the taxation of crypto assets. I see I do have a couple of questions, and we are coming into land now. So if you do have any questions, it's a good time to pop them in there. Warren says there was a YouTube video that said all crypto assets have to be declared at the airport. Is this true? I'm not aware of that, Warren, but I'm not 100% sure. So I think what you would need to do is maybe have a look at that document, the link on the SARS website around the document that has to be completed now and what exactly has to be declared in there. I must be honest, I'm not 100% sure on that one. And the video also said one has to dispose of crypto at the airport. That definitely doesn't sound right. Okay, I'm not sure about that. That certainly doesn't sound right. Whether you have to declare it, that I don't know. I haven't come across that, but of course, things can change quite quickly. This we know. All right. So, yeah, I mean, that really brings me into the end of what I wanted to discuss. So, I'm going to just give a couple of minutes if there are any questions. So, you're welcome to pop them into the chat box if you do have anything that you would like to ask or comment on. And in the meantime, perhaps I should hand back to Stan.
Thanks very much, and great afternoon. Very well put together.
Oh,
And
Stan, just to go back
informative.
to Jack, there is a further point on Ati's question.
Okay, sure.
Oh, I see. That issue around Section 12E4, no person may hold shares in any other company except, and then it lists certain companies. Yeah. No, look, I think there, and I mean, that is a very specific issue, but let me just see if I can give you some kind of guidance on that. So if we look at Section 12E, I see what you're referring to. Is it saying that all the shares must be held by natural persons and no person at any time during the year of assessment can hold shares or have an interest in any other company other than certain permitted investments. And it talks about listed companies, collective investment schemes, company contemplated in 10(1)(e). I'm trying to see which one you're talking about here. Social or friendly society, less than 5% in a primary savings bank, venture capital company, etc. So it lists very particular companies there that are permitted investments. All right. And the idea is that no shareholder is allowed to hold shares in any other company other than those permitted investments. And yes, as you mentioned in your original query, the concern is around splitting income to try and fall within that 20 million rand threshold. George, is there a comprehensive guideline on how to fill a return for a freelancer? No, not as far as I'm aware, but you will find a lot of guidance in the SARS comprehensive guide on completing your tax return. It's just that, of course, you're running a business, and so you've got your income and you're claiming your deductions and so on, and you've got things like home office expenses. So I think the main thing is to think about what are the components of that calculation, and then perhaps have a look to see if there's any guides around, like a guide on deduction of home office expenses or interpretation note there is actually on home office expenses and things like that. Kind of build your own little guide from that. But start with the SARS comprehensive guide on completing the ITR 12, because there's a lot of information that is contained there. Okay, yeah, that's all from me then. Thank you.
Okay, thanks very much, Jackie. As I said, very well presented, an interesting afternoon. Danny, is there anything you want to say about forthcoming webinars?
Yeah, let me open that quickly up.
Put you on the spot.
Yeah, I was also just reading there's another question.
Shall I answer this question while Danny's thinking
Yes.
about the forthcoming webinars?
Please, yeah.
So Yusuf is referring to the announcement in the budget that they would extend the VDP relief. Well, they're not going to specifically extend the relief to interest, although initially, way back before they actually promulgated these provisions, they did consider interest as well under the VDP. So it is possible that they put that back in, or they just make it possible that you can apply for the interest waiver provisions. But that hasn't been promulgated yet. So we have to wait and see when the draft legislation comes out, which I expect should be within the next couple of weeks, and then we'll have a clearer idea of that. Okay, thanks.
Danny?
All right, so next one up is we're going to have Roxana Naidu, who's going to deal with tax debt and disputes with SARS. So I think that should be a nice, interesting one next month, the 27th of August. So that is
Mhm.
what's we got coming up. Notice will obviously go out next week.
Yeah, that will be done. And just on a point of the certificates and payments, if for any reason you haven't received any of the certificates for this webinar and any prior ones, kindly let me know, because we do make mistakes, not often, but we do. And if you can let me know, I'll definitely rectify them. And once again, thank you for the afternoon. Thanks, Danny. Thanks, Jackie, as usual. Very informative. And thank you, everyone, for attending. And have a good evening.
Thanks very much. Bye-bye, everyone.
Bye.
Cheers, everyone. Thank you.